If you have money sitting in a regular savings account at a traditional bank right now, there is a very good chance that account is paying you almost nothing in interest. We are talking about rates as low as 0.01% per year. On a $10,000 balance, that is $1 in interest over 12 months. $1. Meanwhile, high-yield savings accounts, which are widely available and federally insured, are paying rates that in recent years have been anywhere from 4 to 5% or more. On that same $10,000, that is $400 to $500 per year, just for moving your money to a different type of account. Today, we are going to explain exactly what a high-yield savings account is, how it works, what to look for when choosing one, and what the catch is, because there are a few things worth knowing before you open one. A high-yield savings account, commonly shortened to HYSA, is a type of savings account that pays a significantly higher interest rate than the national average for traditional savings accounts. The term high yield simply means the account generates more interest on your deposited money. These accounts are offered primarily by online banks and credit unions, rather than the large traditional banks that most people are familiar with. The reason online banks can offer higher rates is straightforward. They have far lower operating costs because they do not maintain physical branches. They pass those savings on to depositors in the form of higher interest rates. The interest on a high-yield savings account is expressed as an annual percentage yield, or APY. This figure tells you how much your money will grow over the course of a year, accounting for the compounding of interest. So if an account advertises 5% APY and you deposit $10,000, after 1 year you would have approximately $10,500, assuming the rate stays constant and you make no withdrawals. The actual rate you earn may vary because most high-yield savings accounts have variable interest rates, meaning the rate can change over time based on decisions made by the Federal Reserve and the broader interest rate environment. The most important thing to verify before opening a high-yield savings account is whether it is federally insured. Most accounts at banks are insured by the FDIC, the Federal Deposit Insurance Corporation, up to $250,000 per depositor per bank. Accounts at credit unions are typically insured by the NCUA, the National Credit Union Administration, for the same amount. Federal insurance means that even if the bank itself failed, your money up to the insured limit is protected. Always confirm FDIC or NCUA coverage before depositing money anywhere. High-yield savings accounts are not the same as investment accounts. The money in a high-yield savings account does not go up and down with the stock market. It grows at whatever the stated interest rate is, predictably and without risk of loss up to the insured limit. This makes a high-yield savings account suitable for money you want to keep safe and accessible, an emergency fund, a down payment you are saving toward, or short-term savings goals. It is not designed for long-term wealth building in the way that investing in index funds or retirement accounts is. But for money you want to preserve and grow slowly without any risk, a high-yield savings account is one of the most widely discussed options. There are a few things to compare when looking at different high-yield savings accounts. The first is the APY itself. Rates vary between institutions, so it is worth checking what is currently available rather than assuming all high-yield accounts pay the same rate. The second is minimum balance requirements. Some accounts require you to maintain a minimum balance to earn the advertised rate or to avoid fees. Many accounts have no minimum at all. The third is withdrawal limits. Federal regulations previously restricted savings accounts to 6 withdrawals per month. This rule was suspended in 2020, but some banks still apply their own version of it. Check how easily you can access your money and whether there are any penalties for withdrawals. The fourth is how easy the bank is to work with. Online banks do not have branches, so check whether there is a mobile app, customer service availability, and how transfers in and out of the account work. Some of the most widely discussed providers of high-yield savings accounts include online banks and platforms that have built a reputation in this space. These tend to be names that come up repeatedly in personal finance discussions. Institutions known for competitive rates, no monthly fees, and straightforward account management. Links to some of the most discussed options are in the description below. One thing worth addressing is the concern some people have about keeping money at an online bank they are not familiar with. This is completely understandable. The key protection is the FDIC or NCUA insurance. As long as that coverage is confirmed, the institution being primarily online rather than having a physical branch does not change the safety of your deposited funds. The FDIC has not had a depositor lose money in an insured account since its founding in 1933. There is one important concept to understand about high-yield savings accounts and interest rates. The rates available today may not be the rates available in 1 year or 2 years. When the Federal Reserve raises interest rates, as it did significantly in 2022 and 2023, the rates on high-yield savings accounts tend to rise in response. When the Fed cuts rates, those account rates tend to fall. This is why you will sometimes see people discuss locking in rates on other financial products like CDs, certificates of deposit, which offer a fixed rate for a set period. A high-yield savings account offers flexibility but variable rates. A CD offers a fixed rate, but your money is tied up for the term. Both are widely discussed options depending on your situation. To summarize, a high-yield savings account is a savings account that pays significantly more interest than a traditional bank account. It is federally insured up to $250,000. It is variable rate, meaning the interest rate can change over time. It is best suited for money you want to keep safe and accessible rather than money you are investing for long-term growth. And it is available through many online banks and credit unions, often with no minimum balance and no monthly fees. If you have money sitting in a traditional savings account earning almost nothing, moving it to a high-yield savings account is one of the most straightforward steps discussed in personal finance education. Our video on emergency funds covers exactly how much you should be keeping in a savings account and why. Link in the description. And our video on compound interest explains how the interest on these accounts actually grows over time. Subscribe if you want to keep learning. We publish a new personal finance video every week in plain English. See you in the next one.